If you have a 401k, an IRA, or even just a standard brokerage account, you are likely putting your hard-earned cash into a fund. But do you actually know the real difference between an index fund, an ETF, a mutual fund, and a hedge fund? Most Americans don't. And blindly picking the wrong one could literally cost you hundreds of thousands of dollars in hidden fees by the time you retire. A fact backed up by SEC data on investment compounding. Wall Street thrives on making these terms confusing, but today we are clearing it all up. In this video, you'll discover what each of these four investment funds actually is, which one mathematically makes the most sense for everyday beginners, the hidden fee traps in your retirement accounts that are secretly eating your wealth, why ETFs and index funds have completely taken over the US stock market, and the single biggest investing mistake most people make when trying to grow their money. By the end of this video, you'll have the exact framework you need to decide which investment option fits your personal financial goals and which ones you should strictly avoid. Whether you're opening your very first Vanguard account or you've been investing for years, this is the fundamental data you can't afford to miss. Watch till the end, because swapping just one fund today could permanently alter your future net worth. Let's dive in. If you're like most Americans, you've probably done this. You check your brokerage account, you have money sitting there ready to deploy, and then you open the news. The S&P 500 is at an all-time high again, and something in your gut says, wait, this feels expensive. I'll invest after the pullback. That feeling, it's not irrational. It's actually your brain doing exactly what it was built to do, protect you from loss. But here's the problem. The market doesn't care about your comfort level, and the longer you wait for that better entry, the more the clock runs against you. In fact, according to decades of data from JP Morgan Asset Management, if you stay in cash and miss just the 10 best days in the market over a 20-year period, your overall returns are cut completely in half. Every day in cash is a day your money isn't compounding, isn't collecting dividends, and isn't building the kind of long-term momentum that actually changes lives. This is the exact moment most people get stuck, and the hidden cost of waiting often drains more wealth over a lifetime than the occasional market dip ever could. Let's talk about the actual research, because the data on this genuinely shocked me when I first saw it. When JP Morgan Asset Management analyzed the S&P 500 going back to 1988, they compared what happens if you invest on the exact day the market hits a new all-time high versus investing on any random trading day. The result? Buying at all-time highs didn't just survive, it mathematically outperformed. Historically, the average one-year return after an all-time high is nearly 15%, which actually beats the return of investing on a random day. Why? Because all-time highs are signals, not warnings. They tend to cluster during periods of real economic strength in the US, expanding corporate earnings, rising employment, and strong consumer spending. A market that just broke a record is historically much more likely to break another one than to suddenly crash. But here's where most people mess up, and honestly, this is exactly where I used to get it wrong, too. People treat waiting as a safe move. It doesn't feel like a decision. It feels like patience. But sitting in cash has a brutal price tag. It's called opportunity cost, and it's being eaten alive by inflation. While you wait on the sidelines for a 10 or 15% pullback that may take years to arrive, a Vanguard index fund like VOO or VTI bought today is actively working for you, growing through capital appreciation and quietly compounding through reinvested quarterly dividends. The biggest mistake most Americans make right here is confusing caution with inaction. And when it comes to the stock market, they are definitely not the same thing. Let me prove why this matters with a real-world scenario. Meet two hypothetical investors, Marcus and Priya. Both start investing in 2004 with $5,000. Both add $400 per month into a broad U.S. index fund like VTI, Vanguard's total stock market ETF. Marcus, he invests immediately every single month, no questions asked, even when the news says markets are at peaks. He doesn't check the calendar. He just automates. Priya, she's highly disciplined, but every time she senses the market is too high, she pauses. She parks her monthly contribution in a 5% money market account and waits for a dip to get a better price. She averages about 4 to 6 months of delays throughout her investing career. Fast forward to today, Marcus ends up with meaningfully more wealth, not because he was lucky, but because he never gave up months of compounding trying to be clever. The gap isn't explained by timing genius. It's explained by time in the market. If you don't believe me, look at the recent Hartford Funds analysis that tracked the U.S. market over a 30-year stretch. They found that missing just the 10 best trading days cut an investor's cumulative returns by more than half. Sit on that for a second. 10 days out of roughly 7,500 trading sessions, and your wealth is cut in half. And here's the kicker. According to the data, most of those best days happen right after the sharpest drops. They happen when the fear is loudest and most investors are still sitting in cash, waiting on the sidelines. Imagine finally being the person who doesn't flinch at all-time high headlines. Imagine reading that the market hit a record and thinking, good, my investments are working. That's not recklessness. That's understanding how compounding actually builds American wealth. If you want to learn exactly how to set up an automated portfolio so you never miss one of those top 10 days, hit the like button and let's break down the actual funds you can use to do it. So let's land this. The data is not telling you to invest blindly, recklessly, or without a plan. What it is telling you is this: consistency demolishes timing every single time. A regular, automated contribution to a broad, low-cost index fund, whether that's Vanguard's VTI and VOO or Schwab's SCHB, taken rain or shine, peak or valley, is one of the most powerful wealth-building habits you can ever build. The market being at all-time highs is not a red flag. It is, historically, one of the most normal states for a growing U.S. economy. Here are 3 things you can do this week to take control. Number 1, automate your contributions. Set a fixed dollar amount, whatever you can afford, to invest on the exact same day every month. Remove the human emotion from the decision entirely. Number 2, check your exposure. Make sure your portfolio isn't over-concentrated in one single sector or just one country. Broad diversification across U.S. funds and international index funds, like Vanguard's VXUS, reduces the risk that one bad domestic cycle derails your whole retirement plan. Number 3, stop waiting for permission from the market. The perfect entry point is a myth. The best time to invest was yesterday. The second best time is today. You've got the research. You've got the framework. Now it's time to stop letting headlines make your financial decisions for you. If this video helped shift your thinking even a little, drop a comment below. I genuinely read every single one. And if you want more data-backed investing breakdowns built for real people, not Wall Street traders, make sure you subscribe. New videos drop every week. I'm Warren. Go build something.